Director of the Intentional Endowments Network, and I'm really looking forward to our conversation today. We're all dealing with and worried about the devastating impacts of the coronavirus globally and in all of our lives, and in emerging markets in particular, where the risks in terms of the healthcare capacity and the economic impacts are so great. We'll hear today about how ESG and impact investing can support people and communities through both private and public markets. We've got a great group of experts here to share their perspective with years of experience and actively investing right now on the ground. We'll hear from Brendan Mullen of Secha Capital about their work investing in small and medium-sized enterprises in South Africa. Then Irene Gathiaka from Total Impact Capital about an innovative healthcare financing model in Kenya. Then John Simons from Total Impact Capital as well about their work globally, investing for the Sustainable Development Goals. And finally from Carlos Hardenberg, who will discuss Mobius Capital's approach investing in public markets, and particularly around the importance of governance in emerging markets. So this webinar will be recorded and available after the session on our website. And we encourage you to submit questions via the Q&A button at the bottom at any time during the webinar so we can address as many as possible after the presentations. Next slide, please. But first, and just very briefly, for those of you who are new to the Intentional Endowments Network, a little background. We are a nonprofit peer learning network, and we support endowments and other investors in investing in line with their missions and sustainability goals, both to improve their own portfolios' long-term investment performance, and also to address systemic risk and ensure a viable, thriving society for all. Next slide. There are many ways to engage in the network. We've got a resource library on our website, a roadmap for endowments to help boards and other stakeholders navigate these processes, and events and peer learning activities like this webinar. So we encourage you to go to the website and check that out. And if your organization is not already a member, to be in touch and explore joining. Next slide. And so with that, we'll jump right into our agenda. And looking forward to hearing from each of the speakers. Then we'll preserve about 15 or 20 minutes at the end for dialogue amongst the panelists to address your questions, both those that you shared ahead of time and any that you have that come up during the presentations. So again, remember to submit any questions through the window. And now I will turn it over to our first speaker, Brendan Mullen from Secha Capital. Brendan.
Great, thank you, George. And thank you to everyone listening in. I hope you are well and safe and staying healthy. I'm going to put up a slide, but I'd like to keep this a dialogue. So please don't let me pitch too much, but I also like having pictures. I think it helps people remember and follow along. So bear with me one second. Screen 2. So I'll introduce Secha Capital before getting to the slide. Secha Capital is an impact investing micro private equity fund that leads with operations and value add here in Southern Africa. We have started Fund 1 4.5 years ago. We have 7 portfolio companies in the portfolio. Now we're raising for Fund 2, which is a $30 million fund, which is an expanded model. But I think what people are here today is to hear more about what emerging market private equity funds and investors are doing on the ground. And maybe if I could, I'd postulate what we believe in, which is kind of on the left-hand side of this, and now how that is reflected in the new normal with COVID, and why we think this is something that we'd like to see more of, this form of investing, this operator-investor model. So we feel that private equity, or even impact investing, needs to be reimagined for the African context, if you will, not copying and pasting from Silicon Valley. And what we believe in that, primarily are these green boxes. So smaller funds, which means smaller check size and thus a larger pipeline. When you talk to other private equity players here on the continent, they raise these large funds and then everybody's fighting over the same few deals, or they don't have an investable pipeline. By raising a smaller fund and writing a smaller but more impactful check, that can help a lot more businesses on their growth curve. We're also big believers in a cost-effective team of younger operator investors. Now, obviously, from the first one with fund economics, you can't afford to have a gigantic fund of people that look like me or even older. I am the oldest member of the Secha Capital team. So we believe in getting both gender, cognitive, and age diversity into our team. people who are local, who can bring different viewpoints, who understand different markets and sectors, and that's evidenced by our investment portfolio, investing into women's beauty and hair, and even Biltong. As an American, that is not something I would have known about investing from Boston, but I digress. Going on to the next one, we believe in this additionality and duality via impact investing. What do I mean by that? So we want to find a way to grow the SMEs, the SGBs, whichever acronym you prefer. And we feel as though we can do that by being the bridge, getting the best and the brightest in Southern Africa into these SMEs and aligning incentives. Being here on the continent for 8 years as I've been, originally with Bain & Company, I saw how these multinationals have really hollowed out the local talent and kind of decreased the opportunity for entrepreneurship or starting your own business. We believe that our model of impact investing, if we're nothing else, we are a way to bring that high-powered human capital and get it where it's needed most, into these SMEs. Lastly, this is a very repeatable model. To use a kind of a cliche or cheesy impact term, it's biomimicry, which I actually really do believe in. Generally, the first question is, this is a very operational model. Does it scale? And I think it does, but usually I say, no, it doesn't, but it's repeatable, right? There's a lot of local talent that is looking for this opportunity. So does one person scale? No, but it scales for depth, maybe not for breadth, but the model is very repeatable. So going to the right-hand side of the screen, making sure I'm not talking too long, how does this play into the new normal and what we're looking at? Well, this model, maybe borrowing from the bottom, is borrowing heavily from the search fund model that's a lot more popular and common in the US and now increasingly Europe, where we focus on this isn't venture capital, we don't focus on tech alone. I would say tech is a platform, not an industry per se, but it's really reinvigorating these kind of old, essential, boring, fragmented industries. And I think of our portfolio, it's a lot in FMCG, agribusiness, niche manufacturing. Our portfolio companies really do feed, clothe, and cleanse Southern Africa and the rest of the continent, hopefully. So what do we believe we need? And I'll give a quick example at the end. We need proactive value-add investors, whether that's just filling out all the government interventions of the last few weeks, the paperwork, or helping the team hire. So Wukina, which is one of our investments in the wig industry, which is, we've adopted this Avon for women's hair model. So enabling maybe a stay-at-home mom to have a business in a box, a website, for no money up front, you get a commission on selling that. So the Secha team has thrown a lot of resources that way, from talking to other investors who invest in something similar in the US, to updating the route to market locally. Tech enablement into traditional sectors. I think that's one of the key things. It's taking a company like Native Child, which sells natural hair care to women of color, and helping them, setting them up with PayFast, or doing the back end so that it's tech-enabled fulfillment, and not just a person having a store and a fairly static website. And again, these entrepreneurs can do it; they just don't have the bandwidth, right, at this point. And then local champions with robust supply chains. If you'll excuse me, it's a little bit, the cause of the moment, but Stoffelberg Biltong is our second investment. It makes biltong, which is a meat snack, kind of like jerky in the United States. But we also do game and beef and other things like that. And if you look at the supply chain in the United States right now with meat, now you can't even get a burger at a McDonald's. There's a lot of reasons behind that. And that's one of the reasons why I'm very proud to be invested in a meat company, protein, healthy, free range, that can feed South Africa right now. And I'll end in this, where I'm just such a believer of how we're borrowing kind of the ethos of search funds. If you look at the data with the search fund asset class in the US, its IRR is 30+% over the last 10 years. The return on invested capital is ridiculous. And then these jobs that these types of investments are creating are your classic 9-to-5, assumedly health insurance, at least be able to drop your kids off at school. This is not gig economy jobs. So yeah, in summary, what we believe, in a new normal in COVID, and even historically with the private equity or impact investing landscape in Sub-Saharan Africa needs is this growth and human capital. And again, I'll go back to this duality, this additionality that creates duality. So I'll stop there because I know, my colleagues on the call at Total Impact and Mobius are doing great things, whether it's working capital solutions that obviously we need in FMCG space, or eventually getting to listed entities, which I'm also hoping our portfolio will do. But yeah, this is our beliefs. It's our lane. Doesn't mean other people are wrong. Doesn't mean we're necessarily right. But we're big believers in this model, and human capital first, and investing in your classic boring sectors. There can be a lot of growth for financial returns and for job creation.
Excellent. Thank you so much, Brendan. And now we will go from South Africa to another part of the continent with Irene in Nairobi. Irene?
Yes, thank you, Jeff. And I will not start by giving an overview of Total Impact Capital. I'll leave that for John, but instead I'll dive right into the projects that we are working on right now. And it's a little similar to what Brendan looks at, but the model is quite a bit different in the sense that in Kenya, and perhaps in most countries in Africa, one of the pressing needs for SMEs is affordable working capital. And no matter how you slice it, it's still, to access capital, it's rigorous. It ends up costing you quite a bit more than it would in advanced markets. And it's not easily available. So our goal right now is to finance even other sectors, but we are starting with pharmaceutical distributors, so in the pharma sector. And the model will be looking at, instead of getting them to borrow, all the businesses, they can leverage their balance sheet by converting debtors into ready cash at a small fee. And then you release the money right away, as opposed to them having to wait 90 days. And in Kenya, waiting 90 days would be a blessing, because most payers pay way after the 90 days. So what we are looking to do is buy the portfolio of receivables from these SMEs. Of course, there is a qualification criteria to go through, but what it means is that should you qualify, then you don't need to part with things like collateral, you don't need to part with guarantees, and the interest on the facility is capped at when you need it. And so if you revolve, then it renews again, but you don't pay for a whole year for a facility that you only need for 3 months. The idea is that if we give SMEs financing affordably, then they can give better structures or better terms to their underlying clients, who are the retailers. And in turn, those retailers can buy affordably and pass on the benefits to the end user, which is you and me. What we find in the country now is that medicine is not easily available to areas outside of the major metropolitans. If you go a little outside of Nairobi, what you find is that you get drugs that you need, but not consistently. And when you can't get them consistently, then you have to start looking to other places, traveling even further. I know of people who travel 200 kilometers for insulin. And so our hope is that if we can normalize access to medicine, then the benefits can be consistent, and also you can eliminate the the fake products that are in the market. And two, the underlying retailers then can get better terms, and by so doing, they'll expand their outfits, their shops. And hopefully then they can pass on the benefits of better prices, good quality medicines to the end user. That we hope is gonna revolutionize basically the way the pharmaceutical sector gets working capital. And the good thing about this product is that it's scalable and it can be spread across multiple sectors, because anyone with invoices literally can latch onto it and use that as a solution for working capital liquidity trading. And so the idea is that we start with the pharmaceutical sector and then get on to FMCG, we get on to logistics, we get on to any other sector that can use this model. And by so doing, we hope that any other finance provider or financial institutions can relook at the way they provide finance in the market, and perhaps we'll have affordable financing in the market. I'll leave it there for now.
Excellent. Thank you so much, Irene. And now we'll hear from John to speak a little bit more about Total Impact Capital's work around the world. John?
Of course, I muted myself first. So thanks, George. Thanks, Irene. And I'll expand a bit upon the total approach that Irene just described in a particular case that we're utilizing in Kenya. But basically, the focus of Total Impact Capital is on structuring financial products like the one Irene described that help support basic human needs. And actually, in this age of COVID, those basic human needs come with a new name. They're the essential things, the food, the water, the medicines, the healthcare. We went into this with the realization that when you look at at achieving the Sustainable Development Goals, the SDGs, that there were major gaps with regard to provision of these basic human needs. But there were groups on the ground who were already working to implement them. They were just doing them at relatively small scale, often with an NGO or a social enterprise model. And what we sort of try and do is scale up those efforts, utilizing impact investment capital to funnel significantly more resources into the area. In general, we're focused not on equity investing, as Brendan sort of described, but much more, as Irene was talking about, fixed income models. In most cases, when we're dealing with the underlying investees that we deal with, these are, as Irene was describing, small scale pharmacies. These are water cooperatives. These are health facilities, neighborhood health clinics, small scale hospitals. They're not going to, they themselves are not going to, have a 10x or 20x growth, but they can service debt. And often with financing, they become much more efficient. And in essence, the debt pays for itself. So for instance, when a pharmacy can stock its shelves, its cash flow goes up by a significant multiple that makes that debt extraordinarily affordable. When a water cooperative can invest in the right type of pump so it's not wasting electricity and make sure that it can deliver water on a regular basis so its members can pay for the water they receive, not a flat fee, their cash flow goes up and they're able to service that debt. And so it's much more of a model that's built around cash flow, built around servicing fixed income, built around implementers on the ground who have a track record for delivering these basic human needs. And the final element that's critical to our approach is blended capital. So we, the sort of offering that we make to investors is a high impact, competitive return, but relatively low risk investment. And how does investing in water cooperatives in, say, Central America or pharmacies in Kenya become low risk? Well, part of the reason it's low risk, as we've experienced, is that people do pay for their essential services. So the payment risk is actually very low. And if you look at, for instance, one of our vehicles, the Medical Credit Fund, which has been operating for 10 years, it has an NPL rate of non-performing loan rate of 3%. With the water vehicle that we've been operating in Central America now for a little more than a year, we've yet to have a late payment, even with the COVID crisis. So people do pay for those their services, but the other side of it, to make these models work, to convince investors that they're low risk, investing in these bottom of the pyramid service delivery models in what I think most people would think of as relatively high risk countries, is to put some concessional capital into the capital stack so that the investors have a buffer between them and any losses that would occur. And that's a part of how we structure these to offer, like I say, a high impact, a competitive but low risk investment to our investors. That's a fixed income investment, and therefore can also offer the investors a pretty good sense of liquidity. The last point I make is relative to the situation with COVID. So one thing that we're seeing is with essential services, basic human needs, like I said before, people do have to access those, they do have to pay for those. And the cash flows are still flowing even despite this crisis, with one exception I'll mention in a second. But for instance, the pharmacies that Irene was referring to, they're actually doing more business, not surprisingly, in a health crisis than they'd done previously. Under law in Central America, people can defer paying their water bill, but they will have to pay it eventually. And as a result, very few people are actually taking advantage of that accommodation that's provided through the COVID decrees. One area where we do see a challenge is with regard to health facilities, where just like in this country, people are staying away from health facilities, not just because of the lockdown, but also because of fear that there could be an infection there. So the health facilities desperately need access to working capital. We're working through the model that Irene referenced and a few others to potentially provide that, but also to provide them with the funding they would need to invest in PPE and other infection control measures that will give people confidence to go to the health facilities. Because the great fear that most health experts have is that more people will suffer from non-COVID related illnesses than they will from COVID, from avoiding the treatments that they otherwise would likely get. So thanks a lot, and apologies for some of the noise in the background. I think I gave fair warning to my fellow panelists. It's about now is when my house comes alive, and unfortunately it becomes a little bit of a noisy place with everyone back home. Thank you.
No problem. Part of comes with the territory these days. Thank you so much, John. And now we'll hear a bit more along these themes, specifically in public markets, from Carlos. So Carlos, take it away.
Yeah, thank you very much. And that was really interesting. This should now be the time where my 4 children enter the room, but let's hope they don't hear me. First of all, thank you very much for this very interesting exchange here in the panel. Very interesting discussion so far. On Mobius Capital Partners, just briefly who we are, what we do. We set up the firm about 2 years ago, really with the aim to address what we see as a segment in the market which so far doesn't really offer very plausible entry and exposure opportunities. So we saw that within emerging and frontier markets, the small and medium-sized companies which are not part of any of the large indices are highly exciting, highly interesting, very good investment opportunities, but they're to a large extent neglected, not very well understood, and you normally wouldn't really find them in any of the available funds that are out there. So we saw this as an opportunity. We're very passionate about active investing. We're passionate about activist style investing in emerging markets, and therefore set up the fund. It's a single strategy which we focus on. We have a very small team that is looking at global opportunities from frontier markets to emerging markets. The big focus is Asia, of course, where most of the opportunities are. And the sectors which we have a particular interest in are in healthcare, in education, but also in technology and consumer. So those 4 are really the main areas that we focus on. Why? Simply because we see that the both private and public sector spending into those sectors is quite substantial. The demand in those sectors is growing exponentially in emerging markets, where maybe at the beginning, we talked about basic needs, The basic needs were all about, you know, the early consumer goods and services that were available. The second and third generation emerging and frontier market families will spend more money and resources on education, on insurance, on healthcare, and of course on technology. So we think that it's only natural to be interested in those areas, and we think that over the next decade, what maybe used to be infrastructure, what used to be telecom, what used to be resources is going to be more in those segments. Emerging and frontier markets, especially when you go down the market cap spectrum, you will find that companies are far, far behind in terms of transparency. They're far, far behind in terms of governance. And they really need a lot of assistance when it comes to really helping them to understand what this is all about. Many of these entrepreneurs have listed their businesses and they run them still as if they are owned just by the founding family. They don't have a great deal of understanding about the sensitivities of, you know, the capital markets, and especially when it comes to transparency, when it comes to environmental, social, and governance related factors. They simply are somewhat in the dark. Now, of course, some countries are ahead of the curve, some companies are ahead of the curve, but in general, what we are finding, especially in Asia, is that there are huge differences in terms of the quality of the accounts we're getting, the quality of the information. So why this is so interesting? I mean, of course, one thing is we see ourselves as a real activist in these markets to help these companies to speed up in terms of their ESG, for example, rating or their governance policies in general. But the other aspect about this is that it is a unique area where you can actually generate outsized investment returns, simply because often these companies trade at a significant discount because they are not well understood and because they have a low rating. So if we can find those companies which have the right business model, which are run by the right people, and which then will embrace the changes that are needed to make them more transparent and to improve their reputation in the market, we normally have seen in the last, in the many studies that we have done ourselves and that we looked at, that this uptick in rating, this improvement in governance will also translate into a significant improvement in the multiples that they are trading on. So Mobius Capital Partners runs a very concentrated strategy. We have about 22 stocks. We are typically in touch with these companies on a weekly basis. And the Corona crisis, to me, was from the very beginning really a crisis, much, of course, besides being a human crisis, with lots of people passing away, especially in emerging markets. It really was a crisis of confidence and a crisis of transparency and governance. Some countries and companies were far more efficient and far more open in dealing with it, and others, again, were far behind the curve. We've seen in general that in China, a lot of companies were very, very open in communicating how severe the situation is and how incredible the impact has been on the business. And similarly in Brazil, we've seen also a lot of companies reacting very quickly and also making themselves immediately available to investors. So they understood the lesson number one is that you need to be available. You need to make yourself available to your own investors and explain to them what's going on. But of course, in other places of our universe, we've seen problems. Now the question is, how quickly will these companies react? How fast will they invest also in technology? And how quickly will they realize that a lack of openness will actually cause them trouble, because your cost of capital will immediately go up if your rating fall. So the Corona crisis really had multiple impacts. One is, of course, that many of these businesses saw their revenue collapse. We've seen a range of public sector measures which helped fairly quickly. And the range varies between the countries, but overall we are seeing that there has been a large fiscal package that has come through in all of these countries, from Egypt to Brazil to China to Turkey. All of these governments have actually offered immediate help. The range is between 2 and 5-6% of GDP. So we're talking about billions and billions of dollars which are made available to small and medium-sized and large companies. We also have seen policies to protect employment laws. We've seen, of course, a lot of direct help by the public sector banks, which provided loans and capital, working capital to companies. So overall, I would say that partially because we've seen so many periods of crisis and stress in frontier and emerging markets over the last, over their entire history, but specifically over the last 10 years, I would dare say that they were slightly better prepared. Also, there is a much stronger natural social network in place. I'm here in Germany now, and I can see that everywhere in Germany there are initiatives where people are trying to help elderly people to do their shopping, to look after elderly people who have no help. In emerging markets, and I lived most of my life in emerging markets, that is part of their normal lives. Families are much closer together. It is much more natural that you support and help your direct relatives. Families live together, so that has been less of a challenge for them. And it's quite nice to see that this social system, which we always try to cover with insurance policies, is now working in emerging markets just naturally. The opportunity is, of course, an incredible one, because the discount we are observing right now in emerging and frontier markets compared to the US market or compared to the European markets is at an all-time high. So we are seeing in US dollar terms a close to 70% valuation differential. Is that justified? Can that be justified by the numbers? Can that be justified by lower growth expectations, by lower profitability, by lower margins, by higher political risks, by higher macro risks? I would doubt that. And I would say that we will look back at this crisis, of course, mainly focusing on the human catastrophe that is associated with it, but simultaneously we will look back and say that markets have, as usual, overreacted. So it's a good time to look at some of those quality names in emerging and frontier markets. So with that, back to my colleagues.
Thank you so much, Carlos, and thank you all for those great remarks. Definitely a lot of directions we could take this conversation, and we've got some good questions coming in from the participants. But I wanted to start with one that came up several times in the questions from the registration, and it relates, I think, in many ways to your last comments there, Carlos, which is, the dynamics we're seeing right now in terms of how investors are thinking about emerging markets in light of the crisis, and particularly in light of the kind of trends towards ESG and impact investing. Are those factors important to investors? Are they more or less important to investors now in light of this crisis? And how are your limited partners or LPs thinking about new investments in emerging markets now? So that's really one kind of open to all of you. I don't know if you want to run through the same order as you spoke, if you have any thoughts, Brendan or others.
I think it's a great question. And the answer is succinct. COVID maybe exposes realities, but I don't think the game changes that much. If anything, in emerging markets, it means more things need to be local, right? We're imagining a world of protectionism and local supply chains and faster supply chains. So So I think there's more opportunity, from an investor perspective, from a financial, obviously valuations are going to be lower. So this is a buying opportunity, right? The best VC and PE funds vintages come out of downtimes in the economy. But I think this is where the stories align, whether it's equity investing in SGBs like I'm doing, or more invoice discounting and factoring, like Total Impact, is that this is the opportunity for both returns and impact, right? Any number of the SEG/TGs, we focus on 5, 8, and 10, but this is when local ecosystems are going to be built. This is when there are opportunities to join, a company at the bottom, but that has the infrastructure to grow. And this is when the profit pool, I think, mainly is going to shift. It is going to become more diffuse. When you want to buy local, when you want to employ local, I mean, there's going to be, positive outcomes of this and negative. But, I think this is, and I saw the currency risk. Well, emerging market currencies are getting hammered. So that's also an opportunity to buy low. And it means we can export more. So I think there are a lot of kind of positive green shoots coming out of this for emerging markets, almost more than first world. Obviously, Carlos spoke about some of the government interventions, and here in South Africa, we've had a lot of positive policy relative to other countries on the continent. I think I'm getting a little bit out of scope with that, but no, I think this is an opportunity for a lot of emerging markets to come out of this stronger, because it is a bit of a new normal, and we're all going to have to reset to some degree.
Mm-hmm. Thank you. And Irene or John, any thoughts on that one?
Yeah, I would like to add to what Brendan said, and perhaps add that in Kenya, whichever sector you get into, as long as it's not the scene sectors, the guns and the cigarettes, you will be, there will be some SDGs that you could tick off your list, in the sense that you will create jobs. You will be able to, if you're into manufacturing, you will be able to source your goods and raw materials from here. You will, from any market that you get into, you will be able to perhaps improve infrastructure. So even without doing anything extra, you can already tick the SDGs. We are seeing in our, in the deals that we are looking at, the company that we are looking to work with, for a start, has ventured into manufacturing masks. And because they're being manufactured here, it means they can sell them at scale and affordably. So that means they are already protecting people from getting sick, and without changing at all any of their business models. So in countries, in emerging markets, there's ample opportunity to effect those goals, even without changing your business model.
I love that. If I could just add one line that we said pre-COVID, it's a lot harder to move atoms than bits. I mean, we're on a Zoom call right now. That's the US. My $15 a month are leaving South Africa. But, I think COVID makes this even truer. Those masks, you don't have time in the supply chain to make them. That meat that I talked about earlier, you're not going to import that from the United States. And I think that just makes a lot more opportunities. And yeah, so I echo what you said, Irene.
And sort of looking at it from the investor perspective and the investors we work with, I think there are two factors that make investing in emerging markets something that investors, at least the impact investors we work with, more likely. I think one factor that maybe pushes in the other direction. One thing the COVID crisis has, I think, exposed is both the need and the opportunity for these essential services. And I think for people looking both to make an impact and to find something that has, something of a consistent return, the crisis highlights the opportunity to make an impact by investing at the bottom end of the pyramid. I think the other thing that's been very important for our model is that as a result of COVID, there's a lot more concessional capital entering into the market that we can take advantage of to blend with our structures, and therefore balance that equation of high impact, competitive return, and relatively modest risk, even investing in some environments that that otherwise are considered high risk. I think the issue pushing against that is the other thing COVID has exposed is the desperate needs in the global north. And so now investment capital that was looking for impact doesn't necessarily have to travel to Central America or to Africa. There's also significant amounts of opportunity to invest in ways that'll address the yawning gaps that exist here. And so to some extent, for our models that are largely premised on investing in emerging markets, that's competition for the investment dollar that we face.
Interesting. And Carlos, I mean, I know you spoke to several of these, but any further thoughts on that, and then thoughts on the currency risk question as well?
Yeah, sure. I mean, the question was, if I understood it correctly, is ESG of relevance in emerging markets, and why, and how we see the markets now. So first of all, I would say, in our discussions with our investors, we mainly have family offices in Europe that have invested with us, and some institutional investors from mainland Europe and from also from the US. All of them care deeply, not only about the returns that they want to generate, but they also care very deeply about the indirect and direct associated cost with those returns, more than ever before. I mean, I started investing with Dr. Mobius in the late 90s, and of course at that time we spoke about governance and we talked about Russia, you know, and corruption, etc. Which I think now in hindsight were the early, really this was the very beginning of this whole ESG wave, which we are now seeing the peak of. But I think it is of incredible importance to really understand everything about these companies, what the impact is of their business on their environment, on the people they work with, simply because we've seen time and again businesses that don't care about this, businesses that ignore it, have a very high likelihood of running into very, very severe trouble eventually. Either they get drowned by penalties, or they will be involved in corruption affairs, or if they don't treat their own staff right, at the end of the day you pay the price, and the price is often very, very hefty. So therefore the sensitivities developed here are much higher today and much more reasonable. So I think it is very important there. Interestingly, we are seeing that we as investors, when we come into these countries and we work with our networks and our relationships there, they have been catching up so quickly. There are a lot of local initiatives, whether it's in Turkey or in Peru or in Brazil or even in Russia, a lot of very strong local initiatives that push into that direction. And it has an impact on many, many moving parts, including the domestic capital market, domestic bond market, or the domestic. So if you are a Turkish company today and you apply for a bank loan, the bank will scrutinize your ESG policies. So it's no longer imaginable that this will go away. And on top of this, you have the giants like the Norwegian Sovereign Wealth Fund no longer investing in whole segments and industries. So it's really quite a tectonic shift we are seeing. What now in currencies? Currencies is always, to me, one very, very important factor to analyze when making a decision about investing in emerging markets. Right now, if you look at the real effective exchange rates, whether it's in South Africa, where you are based, or whether it's in Turkey, or in now even Asian countries, again, we're seeing a 15-year low. So it's always helpful if you invest in these currencies when they are beaten down like they are today. The risks are very different today than they were 10 years ago. 10 years ago, we had a real tangible debt problem. We had huge inflation. We had huge interest rates. We had a weak banking system. We had very, very dangerous NPL trends. All of this has been to a large extent addressed. Macro looks more robust, and I think fundamentals in these markets look much better. The total debt in these countries is much more reasonable than in many European countries. So I think, again, there's been a bit of an overshooting that we've seen recently. How do we manage it? Hedging is typically very expensive. Hedging often is difficult if you want to hedge over the long term. So therefore, we're trying to diversify, back to basics, diversify as much as possible.
Great, thank you so much. We've got another question here that comes back to the blended finance piece, John, that you mentioned. And Irene, it looks like you've got some thoughts in terms of how successful that's been in Africa. And also the question asks about the regulatory frameworks and how that impacts that approach.
I will start with the blended part of it. And I will say that even before people called it that, that was already very popular in Africa, or at least I'll say in Kenya. I worked in South Africa too, and it worked there even then. And the reason was at the time to hedge their risks and spread it, in the sense that if you're investing in what you consider already a risky market, then you don't want to be the one to take the whole the risk, the 100% risk yourself. So the idea was that to get a consortium of different houses, and you structure that in a way that means that the deal can get done, but you don't take on all the risk. One very popular deal that was done way back when using a similar model is Safaricom, which is the mother of M-Pesa, and M-Pesa has basically revolutionized the way the bottom of the pyramid is banked in Kenya. And it was so successful that many others followed suit. Closer to Total Impact Capital, the deal we're working on now was started by blended finance, in the sense that we got grants, we've got interest from banks, and we've got interest from the shareholders. So there is an equity part of it, there is a MES part of it, and there is a senior debt, and that cushions, first of all, the senior investors that don't want to take on more risk. But it also means that you get different pools, different maturities of your deal, so that you can pace yourself in how you pay back the money.
Great, thank you. Any other thoughts on that? Or?
The only, building on what Irene said, so one of our initial funders was a grant from Convergence, which is an organization created to support blended finance solutions. And I think what we're doing with what's now called INFACT in Kenya, what the health facility that we've helped create, medical credit fund, these are all examples of blended finance. And I think in many instances for our work, blended finance, A, has been successful, but B, it's also somewhat essential, because you need to have a buffer to give investors confidence to venture into these markets that may be much less risky than they imagine, but nonetheless suffer from this perception of high risk.
Great, thank you. And we've had a couple of questions now, and this is something that's a big question in the kind of ESG impact space broadly, but around impact measurement and concerns around greenwashing and with a lack of kind of standards. Irene, you mentioned, in many ways in emerging markets, the impact is almost inherent in a lot of cases. But just curious how each of you are thinking about measuring impact, reporting back to LPs or investors, and if you see that as different in emerging markets than the rest of the space.
Yeah. It's measurable in the sense that depending on what sector you're dealing with, we already know going out that there are segments of people that can hardly get adequate medicine, and when they do, it's very expensive. If you have a starting point as to where you are when you get into the project, then tracking how far you get when you start the project and when you start to finance the pharmaceutical distributors, it's easy to say, this was my base, these are the people that I had to ask to pay on cash because we didn't have working capital before. But now that I have working capital consistently, I can give credit terms to the lower base, the retailers even, to say they can pay in 30 days, and that increases their pool of receivables. And that by so doing, they can then say that we now have a bigger base that we can serve without having to cough up a whole lot more than we do right now. So it's actually quite measurable, even without employing so many apparatus that would be costing you money and time. You can basically say, track, this is where we are, this is what financing will unlock, and this is who comes into the net and benefits from it because we have released a lot more money into the market.
Yeah, for us, it's kind of relatively easy and manageable, because whenever we come in and invest in a company after the due diligence is done, we define along the way what matters the most, where the biggest gaps are. We also then suggest how these gaps should be closed along the ES and the G. And then we manage with the company these improvements as we progress, and report those improvements in a very tailor-made fashion to our own investors. So it's very difficult to kind of have a one solution fits all in these markets. So we think we much more believe in a more tailor-made approach on this. But when you start measuring and you start reporting, you really connect the dots, because obviously the companies themselves and the decision makers, they can also see what we are doing and what we are reporting to our investors. So it creates a little bit of a momentum there, which helps.
I like that last part. Go ahead, John.
All I was going to say is I noticed the question was about greenwashing, and is that a threat? I think it absolutely is. There are a lot of people coming in trying to sort of claim to be delivering impact, and really it has very little bit of a tie to impact. I think the defense against that is to focus on something that creates real value on the ground. And I think the point that Carlos is making is fundamental. If the metrics you're measuring are critical to the success of the business, that probably is an impact business. If you're just doing it to appeal to some investor segment, then you're probably not changing the underlying operations or implementing a high impact operation, in which case the metrics really are beside the point and are not that meaningful.
I think that's really well said. I'd just add one piece that combines the last question, is that with blended capital or complementary capital, we at Secha, our #1 impact KPI is job creation, which is pretty easy, relatively speaking, to measure. And one of the main reasons we accepted complementary capital was to create that discipline. So if nothing else, and blended capital does a lot, it sometimes forces that monitoring and evaluation to actually measure those numbers, track them, and make sure that it's not garbage in, garbage out. So I think sometimes that's the ancillary benefit of that as well. I would only add that with complementary capital, blended capital, it's crucial that the KPIs and the end game are aligned, because as John said, ultimately, or maybe you didn't say this, I don't want to paraphrase, I think it'd be great if we didn't need complementary or blended capital in some of these markets. In Secha, we fundamentally believe that it's not necessary, and I think that we're going to make holistic change of changing the flows and thus the stocks of growth capital in emerging markets. I want to prove that this can be done with growth in human capital. Now, don't get me wrong, if the blend capital is there, which we've done, we take it. And to me, if I'm an investor that doesn't care about impact, that's just rocket fuel on top of the growth capital that I'm putting in there. So that is one of my goals for the impact investing space, is to prove that these things have financial value. I mean, what you and Irene were talking about with John, sorry, it's big on my screen, so I pointed at you. Like working capital, offering that backed by invoices, you're going to make a margin on that. As you said, if you need, concessionary capital to get somebody to invest in Kenya or, other markets that are much, it's tougher to get money into Uganda without that. But I think Southern Africa, parts of this continent, and certainly in Asia where Carlos is looking, there are opportunities for those returns.
Now that's very consistent with what I was saying, Brendan. And basically in all our models, and we've succeeded with this in a few, the goal is to make the blended portion smaller and smaller over time. So you start with a certain amount to attract the more commercially oriented investors, but over time, you leverage that further and further, and then ideally the sources of blended capital can take their concessional capital and direct it elsewhere where there's a greater need.
Beautiful.
But can you agree, Brendan, that it is needed to unlock the rest of the financing? Because when I present the financing deal as a blended structure with the junior debt or the junior financing taking on a bit more risk, then other investors are quite a bit more receptive. So while it perhaps shouldn't be that way, the field that we have to play in is such that you have to have a structure that unlocks the rest of the financing, and blended financing does that.
Yes, yeah, I agree. Yeah, 100%.
Great. So we're starting to run short on time, but I'm hoping we can squeeze at least one or two more questions in here. And Carlos, there's a couple kind of follow-up questions for you around the process. I think you spoke about how ESG improvement can lead to stronger financial performance. And there's a question about if there are unprofitable firms disqualified up front, or can the ESG related activism actually kind of help turn things around? And also, does that work that Mobius Capital does have a follow-on effect and attract other investors? And then along these same lines, the governance issues being prevalent in those markets as you've spoken to, I guess is a little bit more about how you do that to mitigate risk within your portfolio by improving governance.
Okay, the follow-on one is interesting. I mean, obviously, we'd like to say that that's the case. So we do create awareness, and we've been around for a while. So there is a certain degree of investors following us. So we hope that that is the case. And we do promote companies very much so if they go down the right route. So we do an annual meeting here in London. And we invite portfolio companies to, tell the story themselves, how they experienced the collaboration with us, and so that coverage itself is creating a momentum, is creating awareness, and therefore hopefully that will have an impact on the structure of the capital, because ultimately many of these smaller funds, they don't want to be owned only by hedge funds and short-term funds, but more long-term oriented investment funds. So yes. In terms of non-profitable firms, the perfectly honest answer from our perspective right now is we have a small fund, we have a very concentrated strategy, and we need to be very, very cautious and mindful about the kind of risks we're taking in such a strategy. So therefore, we don't want to invest kind of in early stage opportunity. We don't think we need to invest in companies which are non-profitable. We're looking at our universe is 15,000 listed companies. Of course, most of them in Asia, but 15,000 companies. So there is luckily a large number of those companies which are already profitable. They are already run very well. They have a good business model. They've proven that they can make money, but they need a lot of kind of refinement around the edges, and they have certainly neglected many of the ESG parts. So that's where we really focus on. I think if you're a much bigger fund, if you are looking, also if you're less concentrated, you may be able to do that, but that's not really what we do. Sorry, and the last part was?
I think you did cover it in terms of.
I did. Okay, good.
So we're just about at time, but I'd like to close with maybe just one question to ask each of you reflect on. We had a few questions around kind of the depth and how long-term you see the impacts of this COVID crisis being in emerging markets, and also questions around, will we be able to achieve the Sustainable Development Goals after this crisis? And I guess that was an open question before the crisis as well. So maybe just kind of a final reflection on how optimistic you are and where you see emerging markets going from here, from this point. So Brendan, you want to start us off?
Thanks. Yeah, in short, I'm optimistic. by nature, but also what I'm seeing on the ground with what we would maybe call entrepreneurs. These are family businesses, or these are people working in their community. And I think when you rely locally, I'm certainly not anti-globalization, but I'm seeing kind of a little bit more of that from the ground up. And I think for some emerging markets, that it actually is a good thing. So I'm positive. I think this again is more of a diffusion of the profit pools going elsewhere, of people staying on the continent to be seeing the opportunity. Where there's muck, there's brass. Don't waste a crisis. All those cliches. But yeah, I'm seeing positive things there. I mean, granted, I know more people here in South Africa who have died of starvation than of COVID. So that's wildly concerning, and it is a bloodbath out there in the economy. So that's frightening. That's unfortunate. I don't want to dismiss that, but yeah, ultimately, I think this is something to build on.
Great, thank you, Irene. How about you?
I will start with Brendan here. I think he said that perhaps the market might have overreacted because what we are seeing now is that it's raining heavily in Kenya, and we have lost quite a few lives from floods, far more than we have from COVID. But what COVID has done is it has cost whole sectors jobs completely, like the tourism sector. I'm sure it's going to take years to recover because it was already weak to start with, but now we have hotels literally just closing, restaurants closing. And when you look around, at least for Kenya, you don't see the numbers that were predicted. You don't see a whole lot of people in hospitals. You don't see a whole lot of people dying. Not to say that no one has died, but when you look at the magnitude of what the reaction has been versus what's on the ground, then you're left wondering, did we react right? Were we a little too overzealous in locking down everything? As to whether we can recover, there are some sectors like the health sector that's making a lot of money right now. Some people have made the profit they made last year within the first quarter, and then there are those sectors that will need to be you just need to have to pull them up by their bootstraps because they're really struggling. So it's mixed for me. That I do know that we'll recover. The question is how long. Yeah,
thank you. And John?
I think a lot of it will depend on the policy responses, both that are happening now and what happens in the future of the various governments. And I think we're seeing a plethora of different responses, some of which I think are fairly effective. So next to Kenya is Rwanda, which had a very tight shutdown for a period of time, but now is opening up quite aggressively, and thus far has avoided any significant number of cases. We're seeing a little bit of that in Central America, and obviously you're seeing other instances where things seem to be getting out of control. So I think both the policy response to how countries manage the crisis it is now and how they plan their reemergence will be crucial to whether in the short term this crisis has long-term economic effects for the emerging markets. I think in the long term, your question about the SDG 3s and is this going to impact the SDGs, and is this going to impact our ability to meet the SDGs? I think there was an open question whether we would meet the SDGs, as you pointed out, before this ever came up. My hope, and I don't think this is an unrealistic hope, is that this crisis will dramatize the need to make progress on all of these fronts, and in fact, maybe turbocharge those efforts post-crisis, so we may have a better chance of achieving the SDGs after the crisis than we did beforehand. That the complacency around these might be lifted, and people realize that if we don't address many of these gaps, we expose ourselves. Today it's a health calamity. Tomorrow it could be an environmental calamity. We need to take these things seriously, and if that's the outcome of this, I think that is to some extent a silver lining. But it is that's my hope. We'll have to see if that turns into reality.
Yeah, absolutely. Let's hope. Thank you. And Carlos, we'll give you the final word.
Yeah, I think what John said is very much in line with what I've been thinking. I think this could be a blessing in disguise, because a lot of the reform efforts which have been started, but which were handled in a lukewarm fashion, could be accelerated now dramatically. So I think that could really be a force of positive change. Am I optimistic or pessimistic? I think my opinion would be there will be very, very hefty losers after this crisis. There will be companies that will not be able to recover. There will be whole sectors which will continue to be in trouble for a long time. So that's for sure. We're seeing this. We're seeing strong signs of that. And you want to make sure that you stay clear of those. And simultaneously, there will be others which will come out as very strong winners. And one of them, I mean, a good example is what's happening in Brazil right now with online learning, which they started slowly, and now it's accelerating. Most of the large university chains are going, obviously, right now 100% online into online learning. But also in China and Asia in general, we're seeing a lot of business models which are now accelerating dramatically, and they will be strong winners. So there are going to be strong winners and losers overall.
Great. Well, thank you all so much. I apologize we've gone a little over time, but it was a great conversation. We really appreciate all the participants joining us and our speakers today. So thank you. And we'll be in touch soon. Best of luck. Take care.